for investors globally, a profound shift has occurred, making the Federal Reserve's every utterance and action paramount. This unprecedented scrutiny stems from a complex interplay of post-pandemic economic volatility, persistent inflation, and a significant change in the central bank's leadership and communication strategy, demanding constant recalibration of market expectations. Historically, central banks, including the Federal Reserve, operated with less transparency, often adhering to the maxim never explain, never excuse. However, decades of evolution have led to increased public communication, viewed as a critical tool for accountability and effective monetary policy. Yet, the current environment has amplified the stakes dramatically. The initial response to the economic shocks of the early 2020s involved extraordinary monetary stimulus, expanding the Fed's balance sheet to nearly $9 trillion and providing abundant market liquidity. This quantitative easing was crucial in stabilizing financial markets and supporting the economic recovery. However, this period of immense intervention set the stage for subsequent challenges. The unexpected persistence of high inflation emerged as a significant technical dilemma post-2021. Despite initial assessments that price increases would be transitory, inflation became entrenched, rising significantly above the Fed's 2% target. By May 2026, the Consumer Price Index had climbed to 4.2% year-over-year, marking a 3-year high. This inflationary pressure compelled the Federal Reserve to embark on an aggressive tightening cycle, rapidly raising the federal funds rate. Between March 2022 and July 2023, the Fed increased rates by over 5 percentage points in a concerted effort to curb rising prices. This decisive action underscored the central bank's commitment to price stability. Accompanying the interest rate hikes was quantitative tightening, a process designed to reduce the Fed's balance sheet by allowing assets to mature without reinvestment, thereby withdrawing liquidity. However, emerging liquidity concerns in money markets led the Fed to conclude its QT program on December 1, 2025, earlier than many expected, signaling a tactical shift. These substantial policy shifts inevitably introduced significant market volatility. Investors, accustomed to accommodative monetary conditions, faced an environment where borrowing costs rose, impacting corporate earnings and consumer demand. The distinction between the price and availability of money, influenced by rates and QT respectively, became acutely significant. A critical development contributing to investor vigilance is the Federal Reserve's evolving approach to forward guidance. New Fed Chair Kevin Warsh, who took office in May 2026, has signaled a move away from explicit forward guidance, opting for a more data-dependent, meeting-by-meeting approach. This reduces the safety net of prior Fed communication. This new regime means markets are forced to interpret economic data with heightened sensitivity, as the Fed will be less inclined to telegraph its future moves. Warsh's first press conference as chair emphasized a renewed focus on inflation and acknowledged that inflation has been above target for too long. The Fed's decisions are now intensely data-dependent, with key economic indicators driving policy adjustments. Investors closely monitor metrics such as gross domestic product, inflation rates, labor market indicators, and consumer and business spending to anticipate the central bank's next move. The labor market remains a central focus for the Federal Reserve. As of May 2026, job gains continued at a solid pace, with the unemployment rate holding steady around 4.2% to 4.3%. A resilient labor market gives the Fed more flexibility to prioritize inflation control, even if job growth decelerates slightly. Achieving the Fed's 2% inflation target presents ongoing challenges. Despite significant tightening, the Consumer Price Index rose 4.2% year-over-year in May 2026, primarily driven by elevated energy prices linked to geopolitical tensions. Core CPI, excluding volatile food and energy, increased by 2.9% annually. The Federal Reserve's policies also have significant global spillovers. The strength of the U.S. economy, fueled by investments in artificial intelligence and tax cuts, attracts capital inflows, while U.S. interest rate decisions ripple through international markets. Global central banks, facing their own inflation concerns, watch the Fed's actions closely. The perception of a Fed put, where investors believe the central bank will intervene to prevent significant market downturns, has historically provided a psychological safety net. Instances like the 1987 Black Monday and the 1998 long-term capital management crisis reinforce this belief. However, the extended period of high inflation and the new Fed chair's focus on price stability have largely dissipated the explicit Fed put perception. The Fed's commitment to fighting inflation, even if it entails economic moderation, suggests less tolerance for market-driven policy pivots. The bond market, particularly the yield curve, is a critical barometer investors watch. Significant steepening or flattening of the yield curve can signal shifting expectations for Fed policy and broader economic conditions, including potential recession risks. Higher interest rates typically translate to lower bond prices. Corporate earnings are highly sensitive to interest rate fluctuations. Higher borrowing costs for businesses can reduce profits available for investment and expansion, while also dampening consumer demand for finance purchases. Consequently, investors scrutinize earnings reports for any signs of pressure from the restrictive monetary policy. As of July 2026, the market is pricing in at least one 25 basis point rate increase later in the year, a stark reversal from earlier expectations of cuts. This reflects ongoing inflationary pressures and the Fed's unwavering commitment to its dual mandate, forcing investors into an era of heightened vigilance and self-reliant forecasting.